All right, so now we're going to go into the next lessons, which is actually identifying the major lessons, right? So we went through the data collection. We had an idea of what some of those lessons are going to be. So we knew where to dig into. We knew to dig into advanced breakouts. We need to dig into CBOs. We know to dig into management a little bit for just simply by looking at the raw data. Then by going trade by trade in lesson number 2, we went trade by trade and actually analyzed those positions, find common kind of mistakes, just pretty much take notes. So looking at just the screenshots, pure basic analysis, and finding, are there negative confluence factors? What are they? Are there any tips, any repeating lessons, that type of stuff. So at this point is where we put it all together. At this point, you should sit down and read through all of that stuff, through all of those notes, and start writing down things, right? And that's exactly what we're going to do here. I've already put those notes together, right? I already put those lessons together. So let's have a look. Major lessons, major insights from this trader's performance review. So let's have a look. So what we have here on the screen is, again, the same review journal that I put together, but previously we went through all the trades. Now we have the major lessons that I collected from all those setups. So initially we noticed this guy was struggling with advanced breakouts. He took a lot of them, had a low strike rate, okay return, right? So what did I come up with? More precision is needed when trading this strategy, period, right? He was taking a lot of discretionary advanced breakouts that could have been avoided, and just by going through those trades, we eliminated 6 out of 14, right? So more precision is needed, hence the major lesson here. So let's go through the lesson one by one quickly. Let me read it. Focus on major daily support and resistance levels. That is a key. An advanced breakout needs major support and resistance levels, and they need to be rejected, not just tapped, okay? Make sure the intraday trend is finishing a wave 5, major key as well, and has a clear price action pattern. This will develop deceleration on the daily, and you won't be catching a falling knife. Another major key, right? A lot of times a trader can catch a falling knife. This is something that you can use to eliminate that falling knife. Make sure the 1 hour trend has finished, hence a wave 5, right? Make sure you have deceleration. That deceleration on a daily chart gives you the price action pattern on the lower time frame, right? Also, I put it here. This point alone would eliminate many setups and improve your ABO performance, right? It was simple. Also, make sure that if you're taking an advanced breakout as a daily pullback, that you're not trading against strong higher time frame momentum, such as against a new run on a weekly, okay? The above point will also help with this, such as point number 2, right? And there are a couple ABO setups that I reviewed where the daily was more of a continuation play against strong weekly. That's a higher time frame trap. Be cautious about this. So these are 3 really major lessons. Lesson number 1, focus on major daily support and resistance. That is important. You need major support and resistance for an advanced breakout strategy, whether it's a pullback play on a daily chart or whether it's a continuation play on a daily chart. You need some sort of major support and resistance, major 50 EMA rejection, major horizontal level, major trend line, right? Now, number 2, make sure the trend on the lower time frame on the 1 hour chart is actually finished. Make sure the 1 hour chart is finishing wave 5, right? Also, wait for that deceleration on a daily chart. That will develop the triangle, the pattern on a lower time frame. Okay, that's lesson number 2, important. Lesson number 3, make sure that if you're taking advanced breakouts as a daily pullback, that you're not trading against strong higher time frame momentum, okay, such as a new run on a weekly chart. We saw a few examples where the weekly time frame was developing a brand new run. It just had a high test rejecting the weekly 50. Or as an example, it could have these 2 big bearish or bullish engulfing candles. That is a new run on a weekly chart. That is acceleration on a weekly chart. That is momentum on a weekly time frame. And remember, you're taking an advanced breakout pullback against massive momentum. That is catching a falling knife, right? So that is another major lesson. Do not trade advanced breakouts against major higher time frame momentum. Sometimes patience is important in that case. If you're seeing that there is major momentum on a weekly chart, as an example, such as that big weekly high test or strong weekly bearish candles or whatnot against you, right? And you're taking that pullback. If there's so much momentum and you can identify it on that chart, a lot of times you'll be able to. It's right there. It's right in front of you. So if you can identify that higher time frame momentum, that weekly momentum, where you're taking that daily pullback, you might want to step back, apply patience, make sure it decelerates. If you miss that advanced breakout, who cares, right? Because you can still take that IBO or the CBO, right? And an IBO and the CBO at that point will have more development, higher strike rate, because there's more development, there's more confluence factors, there's more lower time frame development, there's price action and a trend change on a lower time frame. So those are the three major lessons for advanced breakouts. ABOs, be picky with them. If you apply these lessons, anybody can improve their advanced breakout strategy, their strike rate, and so on, their win rate. That is how you improve it. That is how this trader can improve it. Now, lesson number 2 was the complete breakout strategy, right? We had a few lessons there. Missing great CBO setups. Why, right? Dig farther into CBO setups and find the reason behind why you're missing so many of them, okay? The number of CBO trades should roughly match the number of IBO setups, maybe even slightly more. This guy had about 22, I believe, IBOs and only 6 CBOs, if I'm not mistaken, right? Suggested exercise, backtest 2019 CBOs to see which daily runs you missed, and if there were CBOs there that could have been executed, and if so, why did you miss them, okay? That is, again, an important lesson for CBOs, since we cannot find many CBOs within the journal review because he's only taken 6. So we can only review 6 CBOs, but the issue here was that he missed so many, right? Because typically CBOs are roughly equal with IBOs, from my perspective, from my opinion. So that is just my opinion. Over the years, I typically have as many IBOs as I do CBOs, right? A lot of times I have more CBOs than I do IBOs. The CBO is the strategy that has the most development. It is the strategy that has the most confluence. It is the strategy that should have the highest strike rate. And a lot of times the best return, right? So in my opinion, that is a big flaw, that you miss so many CBOs. Hence why I gave homework in this case. The homework is review 2019 and see which CBOs you have missed. Take a note of them and put them as a kind of a file. Look, these are all great CBO opportunities. Let's remember that, right? Then lesson number 3, management style. Okay, there were a few things here. So own your short-term trading personality, own your short-term trading style. That's the major lesson, right? So points, work on your management and own your personality. You question your management a lot, specifically in holy grail setups, the setups that have beautiful higher time frames, because you're utilizing short-term management approach. So if you prefer short-term management, own it, unless you truly want to develop the longer-term approach. If you choose short-term management and manage accordingly, don't then say that you should have used a different management style to capitalize on more profit. That is a form of FOMO, fear of missing out. A lot of traders have this, guys, right? A lot of times a trader A takes the same setup that a trader B and the trader C. Trader A might take it as a day trade. Trader B might take it using short-term management. Trader C might take it using long-term management. Trader 1 is a day trader. Trader 2 is a hybrid trader. Trader 3 is a swing trader, right? And then the swing trader could have potentially made more profit using the long-term management, 4-hour 50 EMA. But trader 1, the day trader, took a quick trade, maybe 1 hour Fibonacci extension, targeting 1.32, whatever, just targeting 1 hour Fibonacci extension, made a nice 2% or a nice 3%. The guy who used short-term management, the hybrid trader, maybe made 4 or 5. The swing trader maybe made 6 or 7, right? And then you have trader 1 and trader 2 question themselves because they followed their plan, but they question themselves because they saw the third trader make more profit. But they're a swing trader, whereas the other guys are a day trader and a hybrid trader. Own your personality, guys. Own your style. Stick to it. Don't flip back and forth between personalities and management styles. The management style is based on your trading personality, which is based on your trading plan, period, right? You only switch your management when you have a large data collection, and then you choose, hey, I want to be more of a swing trader. I'm going to use long-term management instead. Period. It's a whole shift in psychology, right? A day trader is a day trader, a swing trader is a swing trader, a hybrid trader is kind of a mix of both. Make sure you identify when we're doing a trading plan, we're going to identify exactly what is your personality. You're going to build a trading plan based on that, and then execute. Own it, own your personality, and execute based on it, right? That is the lesson here, because this guy was questioning himself a lot because FOMO, fear of missing out, right? Where he doesn't have to, he just owns it, own his personality, because a lot of times that consistency will give you the actual return. It's the consistency that gives you the good return, not one or the other management styles. Consistency. Choose one, stick to it, or build some kind of a hybrid model between both. Like I suggested to that one trader, maybe you can choose close 50% on the short-term management and close the other 50% with long-term management. As an example, that could be like a hybrid management personality. Lesson number 4, the Elliott wave theory. Okay, I put a note in here, improve the use of this concept in conjunction with multi-time frame analysis. Why? Gain more knowledge on how to use Elliott wave theory in conjunction with multi-time frame analysis. You mentioned a few times in your notes that you struggle with identifying the larger picture. Understanding the Elliott wave theory will help you greatly with this and enable you to get in sync with the market. Okay, and the suggested exercise, watch the Elliott wave theory lesson from MasterClass 2.0, and so on. So why is this so important? Why is the Elliott wave theory so important? Well, we noticed from the journal, the data collection, the spreadsheet, that this trader was taking a lot of 1-to-1s, a lot of kind of 2-to-1s, and his average return per trade was below 1%, right? It was roughly 1% kind of thing. We want to increase the average return per trade, right? The higher that is, the lower your strike rate can be. But if your strike rate stays the same and you increase your return per trade, obviously you make more profit. One way of doing that is by learning how to read the higher timeframes better, to identify whether we're in a pullback or whether we're in a run on the higher timeframes. One of the easiest way to do that is to know how to use the Elliott wave theory, is to know whether there's a wave 1 breakout on a daily chart, an advanced breakout, whether there's a wave 3 run on a daily chart, an IBO or a CBO, whether there's a wave 5 run on the daily chart, a CBO or an ACB. Right? If you're able to identify the higher time frame picture, right, the higher time frame patterns, and you can identify, is this a wave 2 pullback or is this a run? And if you can see, and if you can clean up those higher time frames and see it more from a strategy, see it more from patterns, not just kind of discretionary analysis, hey, I have this horizontal level, I have a low test, I'm going to take a trade. See it from a whole picture. What is the overall pattern there? What is the overall price action doing? Is this a run? Is this a pullback? Is this a wave 1, wave 2, wave 3, wave 4, wave 5? Or is it simply discretionary? It doesn't fit the patterns. It's kind of a discretionary trade because it's within a range. If you learn how to identify the higher time from price action better, guess what? Now you'll be able to catch those runs and take them for 3, 4, 5%, right? And then when it's the pullback, you can be more quicker with your execution, be more of a day trader, right? So that is the lesson for the Elliott wave theory. This lesson was mainly there to increase the general reward per trade. The way to do that is learning how to read the higher time frames a little bit better. And I find that looking for the Elliott wave theory in the higher time frames or looking for the strategies in the higher time frames helps a lot by identifying the bigger picture and therefore getting a larger return per trade. So those are the major lessons, right, that were kind of identified from that. I also have this appendix here of rough notes. These are pretty much the rough notes that were collected from the trade review section. These are the major lessons, and these are the rough notes, okay? So these are kind of just rough notes, and you can kind of read them for yourself really quickly. I'll just scroll through this, right? So we have some action items, backtest 2019, watch the new Elliott wave theory. So you can do this for yourself, right? Discretion, when you have many great confluence factors and there are just 1 or 2 things against you, and in general a higher reward risk ratio, you can use a little bit of discretion and execute the trade, right? So slight use of discretion, more precision. So if you have a lot of great confluence factors and just one or two things against you, you can use a tiny bit of discretion when executing, right? Management and missing percentages, FOMO regarding missed percentages, we talked about that. Bit of conflict because you prefer short term, so own that short term personality, right? And there are some general notes here on Euro Kiwi. Some more notes on missing trades. So he missed trades due to order entries, right? He doesn't like to take order entries, so he says he missed a lot of positions because he didn't utilize order entries. He will be taking them live instead of placing order entries. Placing an order is a limit order, right? Is sometimes good, right? I use limit orders a lot rather than always waiting for live entries. And that's how you miss a lot of CBOs. This trader missed a lot of CBOs from his point of view because he couldn't get a live entry with a good 1-to-1 reward risk ratio. Well, if it's a good trade and the only issue is that you cannot get a 1-to-1 reward risk ratio with a live entry, then maybe consider placing an entry order instead, because it's a great trade. You want to get into it. You want to make money, right? So you have to get comfortable with entry orders. So that's something you can backtest, something you can play around with, and so on. Right? So you can read those notes a little bit more. There we go. So Kiwi Swiss, management and setting targets, could have pushed farther as there was a weekly high test in his favor. Elliott wave theory, whenever it's wave 5, a lot of times it can stall at the bottoms or it can continue to 0.61 Fibonacci extension. So you see, these are just rough notes, right? And then you put them all together and you start to make little rules for yourself, little tips for yourself, or major lessons, right? Here's a little tip or a little rule. Place targets 5 to 10 pips above or below the support and resistance levels that you're targeting, so that your target is not missed, as an example. And if you prefer short-term management, make sure you own that, right? And that's kind of it. So I'll just kind of show it here for you guys. You guys can read it for yourself. These are just general notes after talking to the trader that we pulled together. A lot of them are tips. Some of them can be rules and guidelines. Some of them are major lessons, right? So that is it. So in general, that's what a proper journal review looks like, guys. A lot of times, let me just close this. A lot of times you will have, when you're doing a journal review, it starts off with simple data collection, looking at the spreadsheet and seeing what you can find there, getting a general kind of overall picture on your performance, right? And then you dig into the trades themselves. When you dig into the trades, you're just taking notes. You're looking at one screenshot. You don't look at the previous analysis. Don't look at your review from previously. Just go blank. Here's my screenshot. Here's the trade. Here's the higher time frame. Here's the lower time frame. What am I missing? What did I miss? Based on my current experience level, what can I identify? What are the negative confluence factors that I see potentially? And then as you go through that, you will start seeing patterns. So once you're done, you put it all together. You have the rough notes, which is the appendix that I showed you, right? And then from those rough notes, you put things that are major, you put them in the categories. Here are my major lessons for advanced breakouts, because he was struggling with advanced breakouts. Here are the major lessons for CBOs, complete breakouts, and how you can improve them. Here are the management lessons and management style, and some tips on how you can improve that, right? And here's a lesson on how you can improve your higher time frame analysis so you can pull more profit out of the market, the Elliott wave theory and so on, right? So you have a list of everything, all your rough notes, and you can read through those. But then you want to put them together, right? The ones that keep on repeating, the true lessons, put them into little categories, right? And then you have a whole journal review package. That is literally what the whole package looks like. So if you do this quarterly, you will have your quarterly journal, your trades from that quarter, fully reviewed with notes. You will have your major lessons, the things that you have to apply. It's not just some suggestions. The major lessons are actual changes things that you got to do, and then you have other suggestions, some rough notes, some things that could turn into lessons or could be little guidelines and suggestions, right, to keep at the back of your mind. And then you have this document, you have a file that you create for yourself every quarter or every 6 months or every year, right? And when you have this as a file, all of a sudden you can review that file. And guess what? This takes a day, guys. This takes maybe, it takes a day, 6 hours to do, so you can do it over a weekend, on a Saturday or whatnot, every single quarter. And literally this alone will help you a lot. So I highly recommend from now on, you do this right now to your journal, your past 6 months. That is your homework. Past 6 months, do this process, right? See what you can gather, see what are the major lessons, the things that I keep on repeating, and build yourself a package. It can look something like that, what I presented to you. It can look totally different. You can put it into a PDF file. You can put it into a folder with all the screenshots and so on. Just make sure that you have a package, and I even recommend printing it out, the whole thing, print it out, right? And then staple it, put it into a document, and now you're an actual trader who knows what you're doing, And that is my recommendation to you guys from now on, this point on. Right now, review your performance for the last 6 months, maybe wherever you want to begin, and dig into that, find the lessons. And then when we're building the trading plan, we're going to start to implement those lessons within it in the next section. That is it for this lesson. In the next one, I'll go a little bit more through general insights, right? But that is the major journal review process. That is how I do it. That is how I recommend you kind of start doing your journal review. And this process will evolve over time, but I find this is a very good, easy, and optimal way of doing it. So again, that's pretty much it for this section, journal review. You can already start digging into it, but in the next lesson, I'm going to give you a few more kind of general tips, notes, suggestions, insights, whatever you want to call it. Let's just call it insights, that when you're doing your journal review, you can kind of refer back to them and be like, I actually start seeing this in my own journal. So those insights, they're lessons that I picked up over time, right? That you can apply to your journal review or to your trading plan and so on. That is it for this. I'll see you in the next lesson. Take care.